Right now, as you watch this video, somewhere inside a data center you will never visit, a machine is analyzing your financial life. Every transaction you have made in the last 90 days, every merchant you paid, every location where your card was swiped, every time you logged into your banking app, every pattern in how much you spend on groceries versus restaurants versus online shopping versus utilities. That machine is your bank's fraud detection system, and it has been running the same basic architecture for the better part of 2 decades. A classical computing system trained on historical transaction data, looking for anomalies that match patterns of known fraud. It flags things that look suspicious and clears things that look normal. For most of your financial life, that system has been the invisible guardian between your bank account and the people who want to drain it. And in September 2025, something happened that made that system, and every other classical fraud detection system in every bank on Earth, look like a black and white television sitting next to an OLED screen. HSBC and IBM announced the world's first empirical evidence that quantum computers can solve real-world problems in financial services better than classical machines, not in a laboratory simulation, not on a synthetic data set, but on 1.7 million real production-scale trade requests from HSBC's actual bond market operations. The improvement was 34%, not 2%, not 5%, 34% better than the best classical methods the industry uses today. And crucially, the classical computers attempting to simulate the same quantum process could not reproduce the results. 2. Key improvement was genuinely quantum in origin. And that result, verified, published, and presented to the financial industry as a world first, is the beginning of a transformation in how money is protected, how fraud is detected, and how the financial system defends itself that most ordinary bank customers have no idea is already underway. Like and subscribe right now, because by the end of this video, you're going to understand exactly what your bank is doing with quantum technology, why the classical fraud detection systems that have protected your money for 20 years are now facing obsolescence, and what this means for your financial security in ways that go far beyond anything your bank's app will ever tell you. To understand why quantum fraud detection changes everything, you have to understand exactly what is wrong with classical fraud detection, not as a vague criticism, but as a precise technical analysis of where the limits are and why those limits keep getting exploited. Classical fraud detection is built on machine learning models trained on historical transaction data. The model learns what normal looks like for you, your spending, patterns, your typical merchants, your usual locations, your average transaction sizes, and it flags deviations from that pattern as potentially fraudulent. This system works reasonably well against the kinds of fraud it has been trained to recognize. Card cloning, account takeover through credential stuffing, unusual geographic transactions, large purchases in unfamiliar categories. These patterns appear in the training data. The model learns them, and when future transactions match them, alerts are trigger D. The fundamental problem is that fraud is not static. Fraudsters are not running the same attacks they ran 5 years ago. They are running attacks designed specifically to evade the detection systems that stopped the attacks they ran 5 years ago. And this adversarial evolution, where the attacker's strategy is continuously adapted to defeat the defender's detection capability, creates a structural disadvantage for classical machine learning systems that goes deeper than any individual fraud technique. Classical fraud detection models are trained on labeled historical data. Fraudulent transactions are labeled as fraud. Normal transactions are labeled as normal. The model learns the boundary between them, but in the real world, fraudulent transactions typically comprise less than 1% of all transaction records. This extreme class imbalance means the model sees thousands of normal transactions for every fraudulent one, and its statistical understanding of what fraud looks like is perpetually distorted by the overwhelming majority of legitimate activity. Complex fraud schemes that operate across multiple accounts, multiple institutions, multiple time windows, and multiple seemingly legitimate intermediate transactions create patterns that exist in a high-dimensional space that classical statistical methods can only approximate. The model is always a step behind, trained on yesterday's fraud, trying to catch today's. And the fraudsters know this. The most sophisticated financial crime networks, the ones running money laundering operations through layered shell company transactions, the ones orchestrating coordinated account takeover attacks using synthetic identities assembled from data breaches, the ones executing market manipulation schemes across correlated securities that design their operations specifically to stay below the threshold of what classical fraud detection can perceive. They exploit the model's blind spots as deliberately as a burglar exploits a gap in a security camera's field of view. McKinsey's financial services research has documented this explicitly. Classical machine learning systems face structurally intractable challenges in this domain, with fundamental computational and statistical constraints that create the gaps that sophisticated fraud exploits. And this is precisely the problem that quantum machine learning is uniquely positioned to address, not incrementally, but structurally. The HSBC and IBM experiment, announced on September 25, 2025, is the single most important data point in the quantum finance story to date, and it deserves to be understood in full technical detail because the details are what separates it from the decades of quantum promises that preceded it. The study analyzed 1.7 million real trade requests spanning 294 trading days of European corporate bond market data, production scale, real-world financial information, not a synthetic test dataset. The problem they were solving was predicting fill probability, whether a given bond trade request would be successfully executed at the quoted price. This is one of the most complex prediction problems in financial markets because it depends on an intricate web of real-time market conditions, counterparty behavior, historical volatility, liquidity signals, and timing factors that interact in ways that are genuinely difficult to capture in classical feature engineering. The approach the HSBC IBM team used was a hybrid quantum classical workflow. They did not replace the classical machine learning models. Instead, they used IBM's quantum Heron processor to transform the input data before feeding it to standard classical algorithms, logistic regression, gradient boosting random forest, and neural networks. Each of the 1.7 million trade requests was represented as a 216 feature snapshot, capturing trade attributes and market dynamics across multiple time horizons. The quantum computer applied a nonlinear transformation called a projected quantum feature map to generate 327 quantum processed features per trade request. Those quantum transformed features were then fed to the classical models. The quantum enhanced classical models consistently outperformed the same classical models running on the original non-quantum transformed data. The maximum improvement was 34%, measured by area under the ROC curve, a standard, real-world business problem at scale, and offer a competitive edge that will only continue to grow as quantum computers advance. Jay Gambetta, vice president of IBM Quantum, described it as showing what paper about what quantum computers might eventually do. This is a paper about what quantum computers already did on real financial data, producing results that classical computing could not match. Like and subscribe. Because the implications of that distinction for every fraud detection system in every bank on Earth are exactly what this video is about. The specific mechanism by which quantum processing delivers this advantage in financial data analysis connects directly to the core technical limitation of classical fraud detection. Quantum feature maps, the process the HSBC IBM team used, exploit quantum mechanical properties including superposition and entanglement to embed classical financial data into a quantum state space, and then extract transform features that capture correlations and patterns the original data does not explicitly contain. In plain language, the quantum computer finds structure in the financial data that classical analysis misses, because the data can be encoded into a space with fundamentally richer representational capacity than any classical feature engineering technique can create. For fraud detection specifically, this matters enormously because fraudulent transactions are not simply different from legitimate ones in ways that are easy to measure directly. They are different in subtle, high-dimensional correlational patterns that emerge across multiple features. Simultaneously, patterns that classical models approximate with decreasing fidelity as the fraud scheme becomes more sophisticated. A quantum-enhanced model operating in a richer feature space can distinguish fraud patterns that look identical in the classical feature space. The research published by Aston University's Quantum Machine Learning Group specifically addresses this. Classical machine learning faces structurally intractable challenges from fraud datasets with extreme class imbalance, non-stationary distributions, and high-dimensional feature spaces. Precisely the characteristics that quantum machine learning offers advantages for addressing. Italian bank Intesa Sanpaolo has been collaborating with IBM to use variational quantum circuit-based classifiers for fraud detection. In their initial results, as documented by both the World Economic Forum and McKinsey, the quantum model outperformed classical methods in identifying fraudulent transactions with greater accuracy, reducing both false positives, legitimate transactions incorrectly flagged as fraud, and false negatives, fraudulent transactions that slide P through undetected. False positives matter for customer experience. Every time a legitimate transaction is blocked, a customer is inconvenienced and trust in the bank erodes. False negatives matter for security. Every fraudulent transaction that passes undetected represents money lost, either by the customer or by the bank's fraud insurance system. Improving both simultaneously, which is what the quantum enhanced models are demonstrating in real-world testing, is not just a technical achievement. It is a competitive advantage with direct financial consequences measured in hundreds of millions of dollars annually. and the World Economic Forum quantified the overall opportunity. Quantum computing applications in financial services could generate up to $622 billion in value by 2035. The UK government, recognizing this, committed $162 million in April 2025 specifically to quantum technology investment targeting crime, fraud, and money laundering through research hubs and pilot projects. The scale of the investment matches the scale of the problem. More than 15 global banks have already established quantum computing research programs. JP Morgan Chase, Goldman Sachs, BBVA, Barclays, BNP Paribas, and HSBC are among the institutions with active programs focusing on fraud detection, portfolio optimization, risk modeling, derivative pricing, and Monte Carlo simulations. Fidelity's Center for Applied Technology collaborated with IonQ, the same IonQ that partnered with NVIDIA's NVQLink quantum bridge to develop quantum models for generating realistic synthetic financial data, which addresses one of the most persistent problems in fraud detection training: the lack of diverse, high-quality labeled examples of sophisticated fraud. Santander and Turkey's Yapı Kredi have been deploying quantum solutions for fraud detection and quantum-safe infrastructure. The Quantum Economic Global Quantum Industry 2026 report documented that the quantum sector drew $56.7 billion in cumulative public funding and $4.9 billion in venture capital by 2025. For financial services specifically, that capital is increasingly being, and any honest discussion of what quantum means for your money has to address it directly. Every time you make an online payment, every time your bank authenticates your login, every time a wire transfer is authorized, every time a securities transaction is settled, that transaction is protected by public key cryptographic algorithms, RSA encryption for key exchange, elliptic curve cryptography for digital signatures. These algorithms derive their security from mathematical problems that are computationally intractable for classical computers, factoring large numbers, computing discrete logarithms, problems so hard that even the fastest classical supercomputers would need thousands of years to solve them at the key sizes banks use. Peter Shor's algorithm, running on a sufficiently powerful quantum computer, solves both problems efficiently. RSA does not become harder to break. It does not become weaker in a way that better classical protection can compensate for. It becomes mathematically broken, not as a gradual degradation, as a categorical failure. A cryptographically relevant quantum computer running Shor's algorithm does not crack open RSA encryption through a side door. It dissolves the entire wall. And the latest research, 3 independent papers published between May 2025 and March 2026, has compressed the estimated quantum resources required to break RSA 2048 from approximately 20 million physical qubits, the previous consensus, to under 1 million in Google's Craig Gidney's 2025 revision, and potentially as few as 100,000 under some newer architectural approaches. The timeline for quantum computers to reach cryptographic relevance has shortened dramatically, and it has shortened at exactly the moment when those computers are already demonstrating real advantage in financial applications. Like and subscribe, right? Your bank account is not a future concern. It is a present operational priority for every financial institution that handles your money. The financial industry's response to this threat is being called the post-quantum cryptography migration, and it is the most urgent and least visible transformation happening inside banks right now. The National Institute of Standards and Technology finalized post-quantum cryptographic standards in 2024. MLChem for key encapsulation, dilithium and Falcon for digital signatures, and Sphinx Plus as a hash-based alternative. These are encryption algorithms specifically designed to resist quantum attacks. The U.S. government has mandated that federal agencies complete migration to these standards by 2030 and 2031. The Department of War issued its first dedicated post-quantum cryptography strategy in June 2026, directing every military system to complete migration by 2031, and explicitly naming nuclear command communications as existential risks if quantum-vulnerable encryption is not replaced. And financial institutions are in the same race, with a timeline driven not just by when quantum computers might become cryptographically relevant, but by the harvest, now decrypt later threat that is already operational. State actors and sophisticated adversaries are collecting encrypted financial transaction data today. Every payment authorization, every wire transfer confirmation, every authenticated session, with the intention of decrypting it when a cryptographically relevant quantum computer becomes available. Banking data encrypted with RSA in 2024 that represents transactions requiring long-term confidentiality, merger negotiations, proprietary trading strategies, regulatory communications, sensitive customer financial profiles, is already potentially harvested and sitting in classified storage facilities waiting for the decryption key that quantum computers will eventually provide. The Federal Reserve published research in 2025 noting that Bitcoin's entire public transaction history, every transaction ever made, all of it recorded permanently on a public blockchain secured with elliptic curve cryptography, faces retroactive exposure when quantum computers mature. Every not a future target, a current target waiting for future capability. Cloudflare reported in April 2026 that more than 65% of human traffic passing through its network was already protected using post-quantum methods, with full migration targeted by 2029. Google has the same internal 2029 deadline. Apple integrated post-quantum encryption into iMessage via its PQ3 protocol in 2024. The technology sector's most sophisticated actors are treating 2029 as the date when quantum-based attacks on classical encryption become operationally realistic. For the banking system, 2029 is not a comfortable planning horizon. Major banking infrastructure takes years to upgrade. Core banking systems, payment rails, authentication infrastructure, API security layers, card processing networks, all of it needs new cryptographic foundations. The banks that are moving fastest are the ones that understand the harvest, now decrypt. Later threat means the vulnerability is not 2029. The vulnerability is right now. Data being encrypted today with vulnerable algorithms is data that may be decrypted later. The window to protect that data is closing with every passing quarter. The dual nature of quantum technology's impact on banking, simultaneously a powerful tool for fraud detection and an existential threat to financial cryptography, creates a strategic imperative that is genuinely without historical parallel in the financial industry. Banks are being asked to adopt a technology that improves their offensive capabilities in fraud detection and risk modeling, while simultaneously defending against the same class of technology being deployed by adversaries to break the encryption that protects their customers' money. This is not like previous technology transitions in banking. The shift from paper ledgers to mainframes, from mainframes, client-server computing, from client-server to cloud. Each of those transitions improved bank operations along a single dimension. Quantum is a two-sided transition, simultaneously an advantage and a threat, with the balance between them determined by who moves faster. JP Morgan Chase's global quantum computing lead has described this directly. The bank is simultaneously exploring quantum algorithms for financial advantage and building post-quantum cryptographic resilience for financial defense. These are not separate programs. They are two halves of a single quantum strategy. The same quantum knowledge that helps a bank understand which algorithms provide advantage in fraud detection also helps that bank evaluate which encryption systems are most vulnerable to quantum attack and which post-quantum replacements provide the strongest protection. Quantum literacy is becoming a core financial competency, not for IT departments alone, but for risk management, for regulatory compliance, for treasury operations, and ultimately for anyone responsible for the financial security of an institution or its customers. For the ordinary person watching this video, the bank customer, the small business owner, the investor, what does all of this mean in practical terms right now? Several things deserve your immediate attention. The first is post-quantum cryptography adoption. The next time your bank sends you a security notice or asks you to update your authentication method or rolls out a new login protocol, the smartest question you can ask is whether it uses post-quantum cryptographic algorithms. Most banks will volunteer this information, but the ones moving fastest are the ones least likely to see your encrypted data exposed in a harvest, now decrypt later attack that decrypts years from now. The second is fraud detection improvement. The quantum-enhanced fraud detection systems that HSBC, Intesa Sanpaolo, and other early adopters are testing will, as they scale and mature, reduce the false positive rate, the frustrating experience of having a legitimate transaction, declined, while simultaneously catching more of the sophisticated fraud that classical systems miss. The benefits of quantum fraud detection will be experienced by ordinary customers as fewer transaction blocks, fewer suspicious activity calls, and better protect you against the identity theft and synthetic fraud schemes that are growing fastest. The third is systemic financial security. The banking decade and its success or failure will determine whether the digital financial system that handles the world's money remains trustworthy as quantum computers become more powerful. Every bank that completes its post-quantum migration ahead of schedule strengthens the system for everyone. Every bank that delays becomes a weak link through H, which a quantum-capable adversary could compromise the trust chain that the entire global financial system depends on. And the fourth is competitive selection. In a world where quantum-enhanced fraud detection is demonstrably 34% more accurate than Classical-only approaches, the banks that deploy quantum capabilities earliest will detect fraud earlier, lose less money to financial crime, offer their customers better protection, and build a competitive advantage that compounds as quantum hardware gap eventually. But the financial crime networks they are trying to stop will not wait. If this video gave you a clearer picture of what is actually happening inside your bank right now, the quantum capabilities being quietly deployed, the cryptographic vulnerabilities being urgently addressed, and the competitive race to protect your money that most customers never see, then please like this video and subscribe to this channel. The quantum transformation of banking is not coming. It has already started. And the next chapter will be written by the institutions that understand it first.